How I became a millionaire stock investor. In this video, I'm going to show you how I became a millionaire stock investor and why you may want to incorporate some of these practices into your own life. First, let me say that I am not a financial advisor and I'm only providing this information for educational and entertainment purposes. After all, investing is risky and I myself have both lost and made significant amounts of money. With that disclaimer out of the way, let's jump in. In my path to seven figures in the stock market, I've identified 4 key principles that help me get there. They are education and mentorship, savings, persistence and consistency, and mindset. Let me start with a story. For as long as I can remember, I've been interested in investing even as a small child. However, being dyslexic and not very good at math, I was hesitant. But at about the age of 11, my uncle married the daughter of a very wealthy man, Mr. H, who had invented patents that were included in the CAT scan, and he held a number of other profitable patents. He was very kind to me and lived in a huge mansion on the north side of Chicago with an indoor pool, an elevator, and 5 Mercedes in each bay of this massive garage. Needless to say, I was impressed. I was fortunate to get to spend time with Mr. H, and we enjoyed talking together. During our conversations, I would ask him about how he created his wealth, and among other things, he told me that you needed to work for yourself, and the money that you made from your own business should be invested. And above all, the invested money should work as hard and preferably harder than you did. My own grandparents also encouraged this approach, as my grandfather told me that he was an early investor in Minute Maid, you know, the orange juice company. And when it was acquired by Coca-Cola in 1960, he made a huge profit, enough for him to buy a nice 3-bedroom house with a 2-car garage, cash, with money left to spare. It was with this encouragement that I made my first investments in the stock market. Of course, I did not have my own business yet, so I did odd jobs to make money, and my parents helped with a little money too. Then, because I was a minor and I could not invest on my own, I got my mother to set up a custodial account for me with a stockbroker. I remember the first investment I made was in a utility company in Chicago called Commonwealth Edison. It was this investment that I learned about the price to earnings ratio and a beautiful concept called the dividend. I was excited to watch the results of my investment as I would track the stock price weekly in the Chicago Tribune. Some weeks I was up, some weeks I was down, but over time there was a definite uptrend in the worth of my investment. Over about a year, the ComEd investment performed well, and I sold my stock and made a little over $300 even after brokerage commissions, which is worth roughly about $817 today. My grandparents and Mr. H all applauded my interest in investing, and even my uncles and cousins were impressed with my results. Now, you may be wondering how an 11-year-old decided on investing in Commonwealth Edison. Utility companies certainly aren't sexy or exciting. Well, I asked for advice from my grandfather and Mr. H. They both said that people will always need and pay for electricity. On top of that, Mr. H had informed me that ComEd had started producing electricity with nuclear energy, which would make the company even more profitable. They turned out to be right, and my investment was worth more than I paid for it. Now, this experience gave me my first clue on the value of education and mentorship in my own investing. I'm going to talk more about this in a few minutes, but let me just say here that this was only the beginning of my investor journey. Over the next couple years, I dabbled with a few other stocks. But as you might expect, from a kid, I lost interest and became distracted. Still, some of my later investments did okay. Several of them were complete bombs. And eventually, sadly, I lost all of my small account. At this point, I became much more interested in chasing girls and then college. Years passed and I grew up and eventually went to law school, launching a legal career and starting a family. Predictably, at this point, my interest in investing was reignited. During this season of my life, I had confidence in my abilities, but remembering the lessons learned earlier in my life, I knew I had to brush up my knowledge and get educated. So, I bought a bunch of books on the subject. It was after reading some of them that I became very interested in options trading. I really loved the concept of covered calls, and I decided to once again try my hand at trading. As it turned out, I was not nearly as smart as I thought I was. My first trade initially made money, then lost value, and eventually I lost more than half the amount I invested. I tried again with similar results. But the experience did teach me that I needed to have a systematized way to save money. I had read the book, The Richest Man in Babylon, a book I commend to you if you have not read it. And it taught me that a part of every single dollar I made was mine to keep. Fortunately, at this point, I was working at a law firm and had access to a 401k. I set up automatic withdrawals directly from my paycheck and saved 20% of everything I made. Since I kept failing so miserably handling my own money, I decided it was easier and better to just put my money into a couple of indexed mutual funds. That is, funds that invested in all the stocks in an index like the Dow Jones or the S&P 500. Now, I will say that the ability to save money automatically made it much easier to accumulate money, and I did. For the next 6 years, I was a consistent saver, but definitely not an active stock investor. Fact is that during my years practicing law, I was actively investing in real estate and making good money doing it. In fact, real estate helped me to build my net worth to over 7 figures, but that's a story for another video. Now, I do realize that many people do not have access to automatic savings where they work. I found this to be a huge problem after I gave up practicing law and started my own publishing business. For several years, without automatic payroll deductions, I saved very little, maybe 1 or 2% of my income, and even that was difficult. One of the ways I solved that problem was by using the Acorns app. Now, I did a video about using that app right over here, but suffice it to say that another key element to my journey to stock market millionaire status was automatic savings. And one way or another, you should get that set up. It was after I went into business for myself that my stock investing journey took yet another turn. As a result of publishing my book, Speak on Cruise Ships, 8 Easy Steps to a Lifetime of Free Luxury Cruises, I got to know many of my readers. And not surprisingly, most of them were very accomplished people. One of these people was Dr. Scott Brown, a finance PhD, a tenured professor, and author of Agora Publishing's best-selling stock investing course ever. So for those of you who don't know, Agora Publishing is probably one of the most successful financial publishers on the planet with about $350 million in yearly sales. In any event, I helped Dr. Brown get booked on a bunch of free cruises, and he invited me to be a guest lecturer at his university on internet marketing. Over time, we became great friends and even traveled together. As our friendship grew and matured, Scott began to help me with my retirement accounts. Slowly, he became my financial mentor and rekindled my interest in investing. Now, about 6 years ago, with Scott's help and encouragement, I went all in and fully committed to investing for my retirement. Along the way, Scott also introduced me to one of his good friends, Lan Turner, who, as it turns out, is a gifted financial educator in his own right and has that rare ability to communicate complex financial topics in a way that makes it easy for a beginner, like me, to follow. Consequently, with their guidance and education, I was able to grow my accounts to well over 7 figures. Now, I had long had $1 million net worth, but there is something deeply satisfying about cracking open your stock account and seeing $1 million plus all on one platform. I will say here that the ride has not all been peaches and cream, not by a long shot. Even with their help, I made some boneheaded investments where I lost significant amounts of money, losing over 6 figures several times. That's where I learned yet another important investing lesson: persistence and consistency. That is, it's super important to stay in the market through both the ups and the downs. This is substantiated by a study Fidelity Investments did in investing a hypothetical $10,000 40 years ago. If you had stayed invested in the market every market day for the last 40 years, your $10,000 investment would have turned into $697,000 in change. But here's where it gets interesting. If you had missed just the best 5 days in the last 40-year span, your investment would be worth only $432,000, or a difference of $265,000. If you had missed the 10 best days, your investment would only be worth $313,000, or a difference of $384,000. But it gets even more interesting when you missed the best 30 days in the market in the last 40 years. Your investment would be worth about $115,000, or a difference of $581,000 in change. You would have missed out on over $500,000. And for the showstopper, if you had missed the best 50 days, just 50 days in the market in the last 40 years, your $10,000 investment would only be worth $48,000 today, or an astounding difference of $648,000 in change. Said another way, you would have missed out on a huge return just sitting out 50 days in the last 40 years. And here's the most important thing I'll say during this video. You can't predict which days will be good or bad in the market. As one thing is for sure, no one can accurately predict the market with any consistency, and far greater minds than mine have tried and failed. So, if you can't accurately time the market, that means you should be in the market every day. This brings me to the last big factor in me becoming a stock market millionaire, and that is mindset. That is, when Scott and Lan started to train me, I began to believe I was going to be successful. My confidence increased as I got more educated. I changed my mindset from one where I saw myself as a bad investor, after all, I had lost a bunch of money in bad trades, to one where I was a good investor, from loser to winner. And as my mindset came in line with the idea that I was a winner, surprise, surprise, I won more. As my knowledge and wisdom increased, I made better trades. But as I analyze mindset now, I realize that this crucial aspect of making good trades started with education and mentorship. That's why if you're interested in continuing or starting your journey as a trader, I've got an exciting announcement for you. In fact, Dr. Brown and Lan Turner have teamed up to launch a brand new streaming channel called the Stock Market Trading Channel. If you're interested, you can check out www.stockmarkettradingchannel.com. It's available on all the major streaming platforms like Amazon Fire TV, Roku, Apple TV, and Google Play. And depending on when you're seeing this, you can even get a free trial subscription. In any event, as I look back on my success trading the markets, education, mentorship, savings, persistence, consistency, and mindset all played a pivotal role. And as you reflect on your own approach to investing, it is my hope that you'll be able to use some of my experiences and insights here in your own investment journey. And if this information was helpful to you, please throw a Hulk smash on that like button. And if you haven't subscribed to the channel, there's no time like the present. Now go out and be the blessing.